Mr. Ben Bennett, active member in our community. Great guy. Hi Heath, thanks again for the vid. Would be great if you could explain basic level, the pops, and taking out stops you mentioned once or twice. Sure thing, Ben. My name is Heath, and this is Trade Talk. Let's dive in. Okay, here you will see a pair, Great British Pound versus US dollar in the Forex market. It's one of my two favorite pairs to trade of all time. I'm going to show you what I'm talking about when I say pops. Some people refer to dips and rips, or sell the pop, buy the dip. It's in reference to trending markets. It's very important that you understand that that concept really only works in a trending market. You see, markets don't move in one direction all the time. They have pullbacks. They have consolidation. So basically when I say sell the pop, what I'm referring to, in a down market, you look for that pullback. Okay, once that pullback happens, now this is a daily chart, obviously. I do a lot of my trading on the 8-hour and lower because I'm a swing/scalper actively in the Forex market. But I'm just giving you a reference as to what I'm talking about and a visual. In a downward trending market, any pop in price or any upswing in price is considered an opportunity to sell into that pop because the market is trending down. So people will look at these pops as opportunities to sell into for continuation. Now here you can see we had an obvious trend change. Okay, now the way I trade, excuse me, shorter term is I look for areas of liquidity to target. So like if I'm taking a scalping trade, I'm not looking to hold that trade for more than anywhere 25 to 40 pips. Once that happens, I have a target level as to where I will already have a limit order to take me out of the trade, and then I will then move my stop loss to better than break even. That way, if or when the market rips back in my face, I am still consistently trying to take out a little piece of profits. They're only scalp trades. They're not designed to get into swing trades. But you can have targets in swing trading as well. I'm just trying to explain my concept a little bit to Mr. Ben Bennett. So basically you can see here we had what looks to be a reversal. Now, I wouldn't really consider that a market structure, as it was in the grips of a few day sell-off pop and then sold into. However, it did find support here and then made a higher high above this. If you measure it above that high there, you can clearly see we made a higher high and then we consolidated. So basically going after liquidity would be this candle right here. Now the market wants to resume up. However, this shorter term low that was made here, traders are really quick to take this and go. They see this as an area to enter. They don't think twice. They don't realize that price can stay in an area for multiple days and weeks before resumption, before making a weekly or monthly range expansion. So this was obviously a support level because market stopped here and reversed. However, it came back, liquidated all the long traders that got long here looking for long resumption. They got liquidated. And then breakout traders will look to go short here. Oh, well, we went up, but then we came back down. Well, breaking out trading is usually only done with candle closures. This daily came down, penetrated the liquidity zone, took out all the stops. If you're taking a long in the Forex market, your stop loss is going to be a sell order. And they're willing sellers. Why are they willing sellers? Well, simply put, this stop loss is a sell order, and they only put it there because they think the market's going higher. That makes them, by default, a willing seller. So the market pushes down to push into that liquidity of willing sellers. That will trigger a lot of sell orders. Smart money or banks or whoever is trading with billion-dollar positions, need sell orders if they want to buy a market. So they generate sell liquidity by purging sell side or buy side liquidity, which is in the form of a sell stop. That triggers all those sell orders. Therefore, they can buy into those sell orders, creating this massive rejection and strong push the next day after, and trend continuation. Markets do tricky stuff like this all the time, and when I'm targeting my areas where liquidity rests under or above isn't necessarily going to be a reversal spot. Obviously, in the market, we don't know what's going to happen. So when I'm aiming for these targets can simply be support or resistance. Now, support and resistance holds. The market decides what price is going to be support and what price is going to be resistance. However, they don't hold exactly. So if you have a line that stopped the market, or here, better yet, let's use the wicks. If you have a line that you consider as resistance because it obviously stopped the market returns back into that area. If you just simply sell that line because price stopped there twice before, you're looking for people like me to just totally eat up your stops, because that becomes an area for me to target. So we took out this open and this open with this move here. That would tell me that there's a pretty good chance that we're going to be aiming for this liquidity above here. And that offers up a 68 pip trade. Now on this following day here, excuse me, you can see price reversed back down, which would give more bias to the downside to traders who are not patient. So this push down is offering me an opportunity. I would go into my lower time frame charts, 15-minute, and then I'll even take positions on a 5-minute chart to try to get those very quick, clear, lightning, precise entries to aim for this line here. Because I know that this is an area of resistance. However, I also know that oftentimes candles will run past those levels to do exactly what I'm talking about. To run liquidity, to soak up all that liquidity or purge it, whatever you want to say, and then sell into it. So resting above this line is buy stops, because people are getting short this. Oh, this is resistance. Let's short it. Bam, put my stop order up here, which happens to be a buy order later, and they think they're doing great. The market reverses strongly. This is where I look to take my scalp trades. I'm targeting that line on the upside and the downside. Now, in my swings trading strategy, I might be getting a little bit off topic here, but I would also sell into this after we've purged the liquidity and taken out that low. That right there is a CTM entry. This is a daily chart. I'm not going to try to go down to a lower time frame because it would take me forever to find this exact spot, but on an 8-hour time frame, that is exactly what CTM is. We sell resistance in downtrending markets and we buy support in uptrending markets. This is resistance in a downtrending market. We sell that. So after the liquidity is purged, after I take my long somewhere in this wick, hit that target, 2/3 of the position out, stop to break even or better, price comes back down, takes me out. I'm looking at my daily chart or my 8-hour chart, and I see obvious that I know this is resistance because I was just aiming for it. So I definitely know it's resistance and has held before in the past. So to enter a swing trade, I would look for that low to be taken out, which it was. Stop above there. Obvious, the range from your entry and stop loss is going to be roughly the same size as my profit targets on my scalp. However, if I'm looking to take this as a swing trade, that is an absolute way I look to take them. Once liquidity is purged, in this case, it's in a sell-off. It's a downtrending market. We've pushed back into resistance. We have purged the liquidity resting above what everybody calls resistance, taken all those stops, and then move forward. This candle right here shows resumption. stop above there, you just wait it out. It's a swing trade. You guys have a great night and a great weekend. Tomorrow I will have my week outlook ahead video coming out, so make sure you subscribe, click the bell icon, like the video, and we'll talk to you guys next time.